You're listening to Ron Siegel's Home and Finance Radio Show, only on Financial News and Talk. Now live in studio, your host, local and national real estate expert and consumer advocate, Ron Siegel.
And hello again. Welcome to Ron Siegel Radio. This is the show with no real boundaries as we discuss current events, financial markets, politics, sports, even poking fun at the rest of the media. This is the show that connects the dots of confusion delivered by conflicting media reports. We connect the dots, you know the actions you can take, how your family or business can benefit from current events. Most of all, thank you for joining me. Within every market, there are solutions as well as tremendous opportunities. You just need some trusted guidance. That is my message, and I will be delivering it every day. We have a very focused show. We only chat about items that affect the roof over your head, your bank account, and anything I feel would benefit you. And let me remind you, if you ever have any home or finance-related questions, I am the consumer advocate looking out for you, and you can reach out to me directly, 800-306-1990, 800-306-1990, or ronsiegelradio.com. Just remember, that's the number you call anytime for assistance. When you call that number, it comes directly to me first. There are operators standing by.
Quiet, numbskulls, I'm broadcasting.
While I do have a great team when it comes to developing a financing plan, a plan to save you money, I personally work with you. Even if you don't have any needs today, save this number in your phone for future reference, 800-306-1990, 800-306-1990. And of course, we are celebrating today. We celebrate every day on Ron Siegel Radio. I love to celebrate. We just have to figure out, what are we celebrating today? Don't have our fancy graphics. Some of our graphic team is a little bit under the weather, so we don't have the fancy graphics today, but I still know it's National Onion Day. That would not be one of my first choices. Orange Blossom Day, PTSD Awareness Day, that's a sad one. Sunglasses Day, I got mine all the time, but haven't beaten anorexia. Yes, I am going with National Ice Cream Cake Day. Ice cream cake. Yeah, I like that one. Let's see what the markets are doing today. What are they doing? It's been a bit of a turbulent day on the markets. Frequently, we see turbulence on the markets lately anyway. Dow Jones Industrial Average now up 24 points. S&P 500 up 1. The NASDAQ is down 43. Oil, 109 a barrel, up $1.51. What's that doing to the world of gas prices? We look at that for you Monday morning. Let's take a look. $6.32 right here in the formerly Golden State. Ow! $6.32. Jody, you're over there at $5.30 a gallon. Okay. Josh is at $5.58. Our tremendous underwriter, Lori, $4.44 a gallon. I'm a little envious, Lori. You're about $2 a gallon cheaper than we are here in Southern California. $4.90 is the cost of a gallon of gasoline on the national level. $4.90. Let's see what else is going on in the world. A lot of news coming out of the Supreme Court. It's the end of June, so we always see a lot of news coming out of the Supreme Court. Been watching all of that news play out. Again, as I did on May 3rd, I'm not going to weigh in on either side of the pro-choice, pro-life issue. I think the biggest issue there is government butt out. 9 unelecteds getting out of the way. Whatever, I'd rather see elected people who are responsible. They have to answer to you and me. That's just kind of the issue right there of the whole thing, in my opinion. But let's take a look and see. Last week, I had the honor and privilege once again to participate or view the Chapman University Economic Forecast. I share with people all the time that I was on the staff back in 1983, some time ago. But it is one of the great forecasts in the country. Love that with Chapman. They are doing a great job over there. So last year, 2021, the forecast was from Chapman. So they figured that if it was a 2021 forecast, that means that they would have made these forecasts in December of 2020. They came out, Goldman Sachs said real GDP 5.9%. Morgan Stanley said real GDP 5.9%. Amherst Pierpont Securities, real GDP 5.8%. Chapman's Anderson Center, Chapman University, 5.7%. RBC Capital Markets, 5.4%. Those were the top 5. There was only one of them that got a bullseye on it. Drum roll, please. Who do you think that the one institution that got it exactly right would have been? My alma mater, Chapman University, 5.7%. It is a bullseye. Good job, guys. Glad to see that you got that one spot on. And now you understand why I follow the Chapman University information so closely, is because they do such a great job of what they're doing out there. Well, the great job, unfortunately, sometimes you like what they have to say. Sometimes it's a little more challenging what they have to say. So they did do some studies, what they do a lot of, real GDP, and they compare that to the money supply. Real GDP in 2021, 5.7%. They finally got those numbers out there. I'm not going to get into the weeds on a lot of the issues that are in there, but one of the comments that I did find fascinating. So, according to Politico, a quote from Politico, they say, and they were quoting President Biden, quote, Milton Friedman isn't running the show anymore. Well, if you know Milton Friedman, or if I've studied under Milton Friedman, a lot of what he has had to say is coming home to roost. The ghost of Milton Friedman, quote, inflation is always and everywhere a monetary phenomenon. Who controls the monetary phenomenon? Well, we're watching all these things. Right now we're looking at what is inflation doing? What is Chapman forecast for inflation? They might have understated this one because they forecast 8%. We're already there. That's not good news if you're watching that particular metric. They're also looked at the Fed funds rate. Well, we're watching that one. They're saying, we're about 175, 150 right now. And the Federal Reserve says they're going to continue ramping that up. They're going to continue going up with the Fed funds rate. Does the Fed funds rate control mortgage rates? No, but there is a bit of a correlation. They showed us a chart of the 30-year mortgage rate, the 30-year actual rate people are paying for mortgages, the 10-year Treasury bond, and Fed funds rate, and they kind of move in a very similar direction. So even though we've seen a very, very low Fed funds rate, or zero, for quite a while, they're talking about where this Fed funds rate is now, where the 10-year Treasury is, and where the 30-year mortgage rate is. And they know that we're right around 6.5% right now. They will probably look at the Freddie Mac numbers. It's just a common number. I had a conversation with the late Essie Adibi one time and made the comment about why do they use the median home income? Because nobody's paying the median home income and it's subjective. And he said, Ron, it is a poor stat. It's not the stat that we want to use, but it's consistent. So that's really where we want to look at, is the consistency of it. So Jody was able to get gas in Prescott for $4.99 a gallon. Unbelievable. That want to become famous, buy five. We don't want, that's just garbage. I'm running solo today. A couple of our team members are ill. So I'm flying solo and didn't read the message before. I posted that out there. Joeo, I don't know. I don't even know the name. So we'll just leave that off. But the bottom line here is Chapman's got a lot of great information. We're going to talk more about that when we come back. You're listening to Ron Siegel Radio, discussing your real estate current events and the financial markets. Well, we got a lot of stuff to go over today. 2 reasons why today's housing market is not a bubble. What FICO score do you need to buy a home? Addressing the decree, the deed, and the debt during divorce, and the power of perspective during divorce. I don't know how much we're going to get to, but we're going to try. You can reach me anytime. Our off-air number, 800-306-1990, 800-306-1990, or RonSiegelRadio.com, Facebook.com/Ron Siegel Radio. And if you miss any part of our broadcast, Ron Siegel 1 on YouTube, Ron Siegel, the numeral 1 on YouTube. Stay tuned. We'll be back in just a few.
Ron Siegel Radio, your home and mortgage connection.
Do you know a homeowner experiencing divorce? Do you know a real estate reference and the divorce decree could cost tens of thousands of dollars? A certified divorce mortgage planning and real estate report could save you thousands of dollars, and it's free from your local certified divorce lending professional. Reach out to Ron today. RonIsMyLender.com. Again, RonIsMyLender.com. Licensed under NMLS 217037, Equal Housing Lender.
You're listening to Ron Siegel's Home and Finance Show with local and national expert Ron Siegel. Now, here's Ron.
Welcome back to Ron Siegel Radio. Within every market, there are solutions as well as tremendous opportunities. You just need some trusted guidance. That is my message, and I will be delivering it every day on Ron Siegel Radio or anytime at 800-306-1990, 800-306-1990. The Mortgage Minute today being brought to you by our friends at Geneva Financial. When you're ready for that next home loan, Geneva's got the programs and the products. You just need me to call 800-306-1990, 800-306-1990. S&P 500 now up 1.35. The 10-year Treasury is up 5 basis points to 3.177. Mortgage-backed securities down 16 basis points. Let's take a look and see what they have to say. OBMMI provides the most comprehensive, accurate, timely, and interactive analysis of pricing ever conducted in the mortgage industry, calculated from actual lock rates with customers or consumers across 35% of all mortgage transactions nationwide. Where were the loans at? This is Friday's data. 30-year conforming, 5.894, up a little bit. 30-year jumbo, 5.445. That one was up just a little bit. 30-year FHA, 5.643. The best loan on the market for those that earned it. The 30-year VA loan, 5.408. And out in those rural areas, 5.622. That's what the loans were locking at according to OBMMI. Why? What's going on in the markets that's driving these issues? Well, we got a housing report came out. Pending home sales measures signed contracts on existing homes increased by 0.7% in May, which was better than the expected 3.7% decrease. Year over year, pending home sales are down 13.6%. Stronger housing market. Now, Chapman was not so high on housing in their report, but I think we'll challenge that a little bit. So after an upside surprise in the new home sales, which rose 14% last month, that's the ones that are just being completed, the new home sales. Actually, I shouldn't say completed. Those are the ones that are being newly built. That doesn't mean they're completed. Pending home sales, which measures signed contracts on existing homes, as I said, rose 0.7% in the month of May. Much stronger than the 4% decline expected, but sales are still down 13.6% year over year. There is no doubt that higher interest rates are impacting demand, but this report does include the majority of the rise. Additionally, the fact that sales were higher with the rise in home prices and lack of inventory clearly shows that the purchase market still remains strong. I just heard this morning that I think there's 7 million homes short. I haven't seen that in too many places. But what does that mean? Well, it means that there's people that want to buy houses, but they can't find anything to buy. They're still getting beat out. They have not gone, and it still drives us nuts, that they have not gone to look at some of the ways well, I'm going to just share it with you. I put together an educational piece over the weekend. It is for educational purposes only. I should say that's the Mortgage Minute brought to you by our friends at Geneva Financial. When you're ready for that next home loan, Geneva's got the programs and the products. You just need to make the call, 800-306-1990, 800-306-1990. So I put together an educational piece. I say it's educational because, the second you do something like this, guidelines may change. Qualifications are never exactly the same. Interest rates change all the time. But I put together this educational piece for a realtor in North Orange County. And he had a listing for $1,499,000. So I put this piece together and said, okay, at that price point, generally that's not a first-time home buyer. Sometimes it is, but generally that's a move-up buyer that's got some amount of equity that they're going to be putting into a property. So we made a few assumptions. We made the assumption of 30% down, well-qualified borrower with excellent credit. At the market price, a given roughly at the time, 5.75% with a 5.829 APR. Gave on this particular property a $7,794 a month payment. But what if we get payment assistance? And I have all kinds of people talking about this stuff, and I just wonder, how do you get payment assistance? Is it short term, Ron? No, this is for 30 years or the life of the loan. Life of the loan. Just call it the life of the loan. How do you get it without impacting parties all over? Well, the bottom line is you go to the seller or you go to their seller's agent and you say, I see, Mr. and Mrs. Seller, that you've got a property here for $1,499,000. Would you mind increasing the purchase price by $37,000? I'll give you an offer for $37,000 above that price. But I want you to use that extra $37,000 to help with the payments. Okay, what can we do with that to help with the payments? Well, maybe we can keep that 30% down payment. That goes up just a little bit. But we can reduce the interest rate to 4.5. 4.865 is the APR on that one. That drops the payment by $637 a month. $637 a month. What does that come out to over 30 years? I think it's more than the $37,000 that you were talking about. Just a guess, being that $637 a month is what, $7,500? Well, it's 72 and through about $7,600 a year. Think about these things. It's all in structuring. You can get advice, but good advice costs a little bit extra. You say, oh, but Ron, what happens if the appraisal doesn't come in at the higher price? We got to be prepared for that. But I'm going to go one step further. What happens if the appraisal doesn't come in at the original list price? What happens if the appraisal comes in at $1,382,000, well below that original list price? But we're going to keep the loan amount the same amount. We're going to keep the interest rate the same amount. Now, just logically, if the loan amount and the interest amount stay the same, what do you think happens to the payment? It stays the same. And through this scenario, this hypothetical scenario, the down payment only went up a little under $2,000. A little under $2,000. Okay, so we're still saving that $637 a month. How much money that saves over that first 5 years? Would it surprise you if I said $155,000 after the costs? $155,000. Over 10 years, you're paying over $100,000 less interest. Over $100,000 less interest. Think about some of these numbers. So what the bottom line here is, we're talking about structure. We're talking about getting a loan structured the right way, or a method that's actually going to solve the issues that the families have. What are the issues that a family has? Well, there's a couple of main issues that families have. Here's the couple of them. Sellers want to get as much money as they can from the property. Just the way it is. The seller's trying that. They're trying to maximize how much they get for their property. Now, if you wanted to buy that same property and get that same payment, if that's where your budget allowed, if that's where your ratio is maximized, well, you may have to drop that property, and I don't have the number in front of me, $100,000, $150,000. Do you think the seller is going to do that? Probably not. But we've come up with a solution here where the seller gets their full list price and the buyer gets a payment assistance. Bottom line there is it's a win-win. The buyer gets what they need, the seller gets what they need, and you go and move on along your merry way because you've paid for some decent advice. Now, there is a caveat here. There's something called high cost and predatory lending laws that strategies like this, if not done properly, they will trigger these high cost and predatory lending laws. So you need to bring our team in at the very early stages of the whole process so that we can help the listing agent and the selling agent write the contract properly so that we address those high cost and predatory lending laws. Already had the conversation with the bank. They understand what we're accomplishing here. They've gone and done their research to make sure that we do satisfy those rules. But when do you think that the compliance work is done to identify high cost and predatory lending violations? Yeah, it's done right near the end of the process. So if that's being done at the end of the process and you don't have somebody helping you with this that knows what's going to happen, you're going to be 3 weeks in getting ready to go to loan docs and you're going to get a surprise. And I don't like surprises. Those are good for weddings and for birthdays and anniversaries. Don't like surprises when it comes to your largest transaction you may ever do in your life. Just throw that out there. You're listening to Ron Siegel Radio, discussing your real estate current events and the financial markets. When we come back, 2 reasons why today's housing market is not a bubble. What FICO score do you need to buy a home, and more? You can reach me anytime. Off-air number 800-306-1990. 800-306-1990 or ronsiegelradio.com, facebook.com/Ron Siegel Radio. And if you miss any part of our broadcast, Ron Siegel 1 on YouTube. Ron Siegel, the number 1 on YouTube. Stay tuned. We'll be back in just a few.
Ron Siegel Radio. Your home and mortgage connection.
Do you know a homeowner experiencing divorce? Do you know a real estate reference and the divorce decree could cost tens of thousands of dollars? A certified divorce mortgage planning and real estate report could save you thousands of dollars, and it's free from your local certified divorce lending professional. Reach out to Ron today. RonIsMyLender.com. Again, RonIsMyLender.com. Licensed under NMLS 217037, Equal Housing Lender.
You're listening to Ron Siegel's Home and Finance Show with local and national expert Ron Siegel. Now, here's Ron.
Welcome back to Ron Siegel Radio. Within every market, there are solutions, as well as tremendous opportunities. You just need some trusted guidance. That is my message, and I will be delivering it every day on Ron Siegel Radio or anytime at 800-306-1990, 800-306-1990. The real-time real estate segment today being brought to you by the area trusted real estate professionals of Ron Siegel Radio. Visit rsrhomescout.com, rsrhomescout.com. I guess during the last segment, I missed the banners that I'm supposed to put on here. Guess they might have to get rid of me on doing the driving of the show. But RSR Home Scout, they've got a great tool that's compliments of Ron Siegel Radio. First tab lets you shop for properties anywhere in the country. The fourth tab tells you what your specific property valued at on 4 different services including the one that is generally incorrect. Starts with a Z. I don't want to get into their name, but just give you that information right there. 2 reasons why today's housing market is not a bubble. You may be reading headlines and hearing talk about a potential housing bubble or a crash, but it's important to understand that the data and expert opinions tell a different story. A recent survey from Pulseonomics asked over 100 housing market experts and real estate economists if they believe the housing market is in a bubble. The results indicate most experts do not think that is the case. 60% say no, 32% say yes, 8% are not sure. In the same survey, experts give the following reasons why this is not like 2008. The recent growth in home prices is because of demographics and low inventory. Credit risks are low because underwriting and lending standards are sound. If you're concerned a crash may be coming, here's a deep dive into those 2 key factors that should help ease your concerns. Number 1, low housing inventory is causing home prices to rise. The supply of homes available for sale needed to sustain a normal real estate market is approximately 6 months. Anything more than that is an overabundance and will cause prices to depreciate. Anything less than that is a shortage and will lead to continued price appreciation. I'm gonna post some graphs later on our page that I can share with you because I can't get them up here right now. But we've got a graph that shows there is a shortage of inventory, which is causing ongoing home price appreciation. So 4 years of the housing crash, the inventory of homes is nothing like the last time. 2007, we had 8.9 months supply. 2008, we had 10.8 months supply. 2009, we had 9.7 months supply. And 2010, we had 8.1 months supply. 2019, we had 4.3 months. 2020, 4.6 months. 2021, 2.5. And 2022, 2.6 months supply. About a quarter of what we had back in the bubble. Inventory is nothing like last time. Prices are rising because there's a healthy demand for home ownership. At the same time, there's a limited supply of homes for sale. Odetta Cushy, Deputy Chief Economist at First American, explains, quote, the fundamentals driving house price growth in the U.S. remain intact. The demand for homes continue to exceed the supply of homes for sale, which is keeping house price growth high, unquote. Number 2, mortgage lending standards today are nothing like the last time. During the housing bubble, it was much easier to get a mortgage than it is today. Here's a graph showing the mortgage volume issued to purchasers with a credit score less than 620 during the housing boom and the subsequent volume in the years after. And again, I can't show you the graph, but the graph shows one element of why mortgage standards are nothing like they were the last time. Purchasers who acquired a mortgage over the last decade are now much more qualified than they were in the years leading up to the crash. Realtor.com notes, quote, lenders are giving mortgages only to the most qualified borrowers. These borrowers are less likely to wind up in foreclosure, unquote. The majority of experts agree we're not in a housing bubble. That's because home price growth is backed by strong housing market fundamentals, and lending standards are much tighter today. If you have questions, give me a call, 800-306-1990, 800-306-1990. And as I always ask, if you have any friends, family, or coworkers looking to buy, sell, or borrow on real estate, can I count on you to send them our way, to send us an introduction? That's the Real-Time Real Estate segment brought to you by the area trusted real estate professionals of Ron Siegel Radio. Visit rsrhomescout.com, rsrhomescout.com. Better Outcome segment today. See if I can find the banner that I'm supposed to put up for the Better Outcome segment. Brought to you by mycdlp.com, mycdlp.com. Better Outcome. Let's just, I know I've got this one right here. I'll tell you while I'm looking for the Better Outcome banner that, remember, you get a free Divorce Your Mortgage workbook. If you're in the world of divorce or contemplating divorce, you got the Divorce Your Mortgage workbook, and it's a great tool to put all of your real property in there. I'm going to just share with you that it's an organizer. You send it to us. We're happy to send back to you a book on it and get you the information. There it is. Better Outcome segment brought to you by mycdlp.com. mycdlp.com. Let me get rid of that other banner if I can figure out where the heck it is. There it is. Let's get you the story. Which one do we have here? Let's take a look. Better Outcome segment addressing the decree, the deed, and the debt during divorce. The deed, decree, and debt all intersect during divorce, yet all three need to be dealt with separately in the settlement process. Therefore, working with a mortgage planner with the right experience is essential during a divorce. This is why it's crucial to bring in a certified divorce lending professional, CDLP, that's me. The deed, when transferring ownership of the marital home from jointly held ownership or sole ownership to the other spouse using the correct transfer deed, a quitclaim or warranty deed is important for protecting the new sole owner. A quitclaim deed is the most commonly used transfer deed yet. Provides the least protection to receiving spouse. Without warranties, it offers the grantee little or no recourse against the grantor if a problem with the title arises in the future. A warranty deed may be much better choice as it provides the most protection to the new owner. This type of deed guarantees that the grantor holds clear title to a piece of real estate and has a right to sell it to the grantee. The grantee is not limited to the time the grantor owned the property as with a special warranty deed. Instead, it extends back to the property's earliest title. As such, earlier grantors occasionally find themselves confronted by issues from future grantees. The decree and the divorce settlement or separation agreements can make or break the divorcing client's ability to obtain mortgage financing. Verbiage included within the agreement should address more than simply stating that Mrs. Smith is awarded the home and will refinance the current mortgage. Verbiage within the agreement should specify the time frame she is to refinance and who is responsible for the existing mortgage payment, taxes, and insurance until the home is refinanced. If not worded correctly, Mr. Smith may have hurdles to overcome when trying to obtain mortgage financing himself in the future. It's always in the best interest of both divorcing spouses to obtain pre-approval for future mortgage finance before the divorce is final. The debt. Addressing all marital debt in the divorce settlement agreement is another critical topic that needs clarity and can affect how debt is considered during mortgage financing. If the debt is joint, specifically address how it will be paid and by whom. Simply stating the parties will share the burden of paying joint debt 50-50 does not cut it. Clarify that each party is responsible for paying 50% of the specific debts and how each party is to pay. For example, Mr. and Mrs. Smith will each share the burden of paying the marital debt 50-50, and each spouse will pay 50% of the monthly payment until the debt is paid. This clarifies how the debt will be counted during the mortgage application process. Working with an experienced mortgage professional, it's always important to work with an experienced mortgage professional working with divorcing clients. A certified divorce lending professional can help answer questions and provide excellent advice. I always share this information. This is for informational purposes only and not for the purpose of providing legal or tax advice. You should contact an attorney or tax professional to obtain legal and tax advice. Interest rates and fees are estimates provided for informational purposes only and are subject to market changes. This is not a commitment to lend. Rates change daily. Call for current information. That's the Better Outcome segment brought to you by mycdlp.com, mycdlp.com. Now, remember, you can get that Divorce Your Mortgage workbook also. Just visit my DYM workbook, mydymworkbook.com. You're listening to Ron Siegel Radio, discussing your real estate current events and the financial markets. When we come back, still got a bunch of stuff. What FICO score do you need to buy a home? And the power of perspective during the divorce. All that and more. You can reach me anytime. Off-air number 800-306-1990, 800-306-1990, or RonSiegelRadio.com, Facebook.com/Ron Siegel Radio. And if you miss any part of our broadcast, Ron Siegel 1 on YouTube, Ron Siegel, the number 1 on YouTube. Stay tuned. We'll be back in just a few.
Ron Siegel Radio. Your home and mortgage connection.
Do you know a homeowner experiencing divorce? Do you know a real estate reference and the divorce decree could cost tens of thousands of dollars? A certified divorce mortgage planning and real estate report could save you thousands of dollars, and it's free from your local certified divorce lending professional. Reach out to Ron today. RonIsMyLender.com. Again, RonIsMyLender.com. Licensed under NMLS 217037, Equal Housing Lender.
You're listening to Ron Siegel's Home and Finance Show with local and national expert Ron Siegel. Now, here's Ron.
Welcome back to Ron Siegel Radio. Within every market, there are solutions as well as tremendous opportunities. You just need some trusted guidance. That is my message, and I will be delivering it every day on Ron Siegel Radio or anytime at 800-306-1990, 800-306-1990. The Borrow Smart segment brought to you by the National Institute of Financial Education. New segment that we've got for you, Borrow Smart segment, again brought to you by the National Institute of Financial Education. What FICO score do you need to buy a home? Buying a home is not only a major life milestone, but also a significant commitment. As such, mortgage lenders typically have stricter guidelines than other loan types when you apply. The minimum FICO score needed to buy a home can vary depending on which type of mortgage loan you're applying for, but the higher your scores, the better your chances will be to get approved with favorable terms. Also, while your FICO scores are an important factor in the underwriting process, lenders consider several other elements as well. Here's what you need to know to make sure you're credit ready to buy a home. Let's talk about the minimum FICO score requirements for mortgage types. Many different types of mortgage loans from which you can choose, each of which has features that may provide a better fit for you than the others. Here's what FICO score you'll typically need to be eligible for each option. Conventional loans. These loans are the most common type of mortgage loan and require a FICO score of 620 or higher. Now, remember, again, we're just not giving any offer or approvals here. And there are certain overlays that need to be discussed. So even though conventional loans may say one thing, finding somebody to offer that product might be a different thing. Jumbo loans. These are considered non-conforming loans because they exceed the Federal Housing Finance Agency's loan limit for conventional loans. You generally need a FICO score of 680 or higher to qualify, but some lenders may set the minimum at 700. FHA loans. These loans are backed by the Federal Housing Administration and require a FICO score of 500 or greater if you can put down at least 10% on the purchase. If you're going with the standard 3.5% down, the minimum FICO score is 580. Most buyers can apply for an FHA loan. VA loans. There's no minimum FICO score requirement set by the U.S. Department of Veterans Affairs. In most cases, lenders will ask for a FICO score of 620 or higher, but some may go as low as 580. You need to be an eligible member of the military community to qualify for this loan. USDA loans. As with VA loans, there is no minimum FICO score for loans backed by the U.S. Department of Agriculture. Most lenders require a FICO score of at least 640, but some may be willing to go lower than that. USDA loans are designed for home buyers who are planning to buy property with an eligible rural area. As you prepare for the home buying process, carefully consider each type of mortgage loan to determine which one is right for you. That's why I say, as I said earlier in the broadcast, advice, it's cheap. Good advice, got to pay a little bit more for it. And just like I shared with you, I think it was in the opening segment, how you can save over $100,000 on interest by paying more for the real estate. You're not going to get that education at a cheapo lender. Just throw that out there for you. Other factors lenders consider in addition to your FICO score. While your FICO scores are a crucial piece of underwriting process, it's only one of them. There are other items mortgage lenders will look at when you apply for a loan. Debt to income ratio. These metrics refer to the percentage of your gross monthly income that goes toward monthly debt obligations. including your proposed housing costs. Most lenders allow a maximum debt-to-income ratio, 43%, but in some may go as high as 50%. Employment. And in addition to your income, lenders will also look at how stable your employment situation is. If you've recently switched jobs or you're self-employed, you may need to clear some additional criteria to get approved. Recent credit. It's generally best to avoid opening new credit accounts in the 6 to 12 months leading up to a mortgage application. New credit cards and loans may increase your debt-to-income ratio, which can make it harder to get approved. Down payment. Down payment requirements can vary, with some types of mortgage loans not requiring one at all. That said, the more you can put down, the better your approval odds will be. It can also help you secure a lower interest rate and avoid mortgage insurance premiums. Liquid reserves. Generally a good idea to have more cash in reserve than you plan to put toward a down payment and closing costs. It indicates financial soundness and can make approval more likely. The property. Lenders typically have guidelines to ensure that the home you're buying is a good investment. This process involves an appraisal and inspection to determine its value and condition. These factors are crucial, so make sure you do more than just focus on your credit scores as you prepare for the home buying process. Bottom line, before you apply for a mortgage loan, good idea to check your FICO scores and credit report to assess your overall credit health. If your score does not meet the minimum requirements for the type of mortgage loan you're eyeing, or it's lower than you'd like, take meaningful steps to improve your FICO scores over time. Actions may include paying down credit card debt, paying down loan balances, correcting errors on your credit reports, and more. Focus on the specific areas of your credit report that are impacting your FICO scores and monitoring your credit regularly to track your process. I'm going to share with you that if you want, give us a call or give us an email or text or any of the above, rj@ronsiegelradio.com, rj@ronsiegelradio.com, and get a Borrow Smart analysis. The Borrow Smart analysis. Also, if you're wanting to know how to pay your credit cards the right way to maximize your FICO score, maximize the FICO score, rsrccpayment.com. RSRCC, like credit card, ccpayment.com. Give you a tool right there. It's free from your friends at Ron Siegel Radio to tell you how to pay your credit cards the right way to maximize your FICO score. rsrccpayment.com. That is the Your Credit Matters segment, brought to you by brought to you by Borrow Smart. It's the Borrow Smart segment, brought to you by the National Institute of Financial Education. Easy for me to say. The Borrow Smart segment, brought to you by the National Institute of Financial Education. I think we got time to give us a better outcome segment. I think we've got time. Better outcome segment, brought to you by mycdlp.com, mycdlp.com. Power of perspective during the divorce. Your perspective is how you see something regarding situations or topics, the appearance of things relative to one another. Multiple perspectives are crucial to gain a complete understanding of a situation. For example, in divorce, different views on different topics can affect the divorcing spouse in different ways, either positively or negatively. Take the following question, for example. How would you calculate spousal support when the paying spouse has fluctuating income or an irregular pay schedule? How would you handle spousal support versus a lump sum payout? How do you evaluate the home equity? How do you evaluate the home equity solutions, and the options available? Your perspective or solution to these questions may satisfy the parties during the settlement process. However, the answer may negatively affect either party when obtaining mortgage financing. Collaborating with the right team players results in different perspectives and better solutions. Make more informed decisions on home equity solutions. There are 3 ways to divide the marital home: equity buyout, selling the home, and dividing the net proceeds or holding the property and selling later. A marital home agreement may state that one party retains the marital home and refinance the existing mortgage. Still, a court cannot dictate which type of mortgage financing is available, if at all. Home equity solutions reach beyond the disposition of real property. Incorporating divorce mortgage planning into the settlement process results in a more positive outcome for both spouses and their families. Divorce mortgage planning is the process of evaluating mortgage options in the context of the overall financial objectives of the divorcing couple, improving cash flow and retirement income, identifying strategic financing opportunities, mitigating potential capital gains taxes, protecting the mortgage interest deduction, increasing qualified income through collaboration. What's my property worth? Even determining the value of real property depends on perspective. The two most common methods for obtaining real property value are obtaining an appraisal from a licensed appraiser or having a real estate professional provide a CMA. But what's the difference between the two? Both methods are an opinion of value, and no two will ever give you the same value. The primary difference is perspective. An appraisal is completed by a licensed residential appraiser who bases their opinion of value on recent comparable homes sold data. A comparative market analysis, CMA, is completed by a licensed real estate professional who bases their opinion of value on what the property may potentially sell for in the current real estate market. While both opinions of value are valid, it is crucial to understand the perspective of each opinion and how the two methods apply to the current situation of the marital home. When considering the option of one spouse retaining the marital home and refinancing, an appraisal may be a better option. If considering a sale of the marital home, a CMA may be a better option. A successful divorce settlement results from putting the pieces of the puzzle together in such a manner that both divorcing spouses come out of the divorce whole. Therefore, each member of the professional divorce team should bring value and perspective that benefits the overall outcome and success. As a divorce mortgage planner, the CDLP, that's me, can help divorcing homeowners make a more informed decision regarding their home equity solutions while helping the professional divorce team identify any potential conflicts between the divorce settlement, home equity solutions, and real property issues. Again, this is for legal information. This is for informational purposes only, and not for the purpose of providing legal or tax advice. You should contact an attorney or tax professional to obtain legal and tax advice. Interest rates and fees are estimates provided for informational purposes only and are subject to market changes. This is not a commitment to lend. Rates change daily. Call for current quotes. The information contained has been prepared by or purchased from an independent third party for educational purposes. Did I say this is for educational purposes only? I just want to make sure that we were clear on that part of it. Just because, we don't want to get in any trouble. We don't want the attorneys to think that we're giving legal advice. We're not attorneys. What we are sharing is just some basic information that we have. We know the intersection of law, tax, real estate, and finance. And where those intersect is something that's very, very important to you. So we want to make sure that you are getting that information from us. And as always, that's the Better Outcome segment brought to you by mycdlp.com, mycdlp.com. And remember, as always, set that first radio preset button to come back and join Ron Siegel Radio, where we only speak about items affecting your house and your bank account. Thanks to all of our sponsors. A big thanks to Josh and Sean, who engineer us all the time. And of course, a special thanks to you for spending a little bit of your day with us. That's all for Ron Siegel Radio. Again, if you have any questions or to meet any of our guests, call me anytime. 800-306-1990. 800-306-1990 or ronsiegelradio.com. And remember, make a lot of money so you can help a lot of people and have a lot of fun. Have a great day. We'll talk to you next time on Ron Siegel Radio.